We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrick. Joining me today is returning guest Chris Vermeulen, founder and chief market strategist of the Technical Traders. Thanks for coming back, Chris.
Hey, thanks for having me, Tom. Always a pleasure.
So let's talk about market leaders and how important these trends can be. Does a rotation of capital into asset classes mark out leaders like this?
It does. And like last year, we had some very clear leaders in the market. We saw technology, clean energy, biotech. We saw a lot of things really take off, and there's some really strong sectors. And this year, there's been a lot of mixture, a lot of sector rotation where the market's trying to figure out exactly where to put their money. And so we've seen, oil energy sector do really well. Real estate's doing fairly well, but we've seen all the leaders of last year. They're all at the bottom of my list of the hot sectors. They're actually all at the bottom. And what was at the bottom last year is now near the top this year. So we're definitely seeing rotation in the stock market this year. And it's tough to trade sector rotation because, you want to naturally follow the leaders, but then they fall behind. And then, the markets become very choppy. The stock market, when you look at the NASDAQ or the Russell 2000 this year, it's really just chopped sideways in a really gnarly range. You really got to be an active short-term trader. We're not seeing like a big trend pick up and then just continue to run. So I think we're going to see maybe a little more sector rotation. We're waiting for some confirmation of where are these next leaders going to come from and when are we going to get conviction. I think we're really close. Any day, the stock market could either start a very big correction or it's going to start another big rally to the upside. And we just have to wait to see which way it breaks before we take some action and get involved in these leading sectors.
So is this a good basis for your strategy of best asset now to really look for a mover and wait for the trend to confirm it?
It is. I mean, there's times in the stock market when in my opinion, there's times when you want to be in equities. There's times when you don't want to really be in equities because the market really chops around and doesn't have conviction. For example, we've got a hot list of about 40 different sectors. And even though they've given buy triggers over the last month, and most of them have given a buy trigger, they're all plus or minus 3 or 4%. There's no real leaders that are up 25, 40%. They're all just chopping around. And when the market is like that, there's, you've got really low odds of picking one that's going to run because the reality is almost none of them have run. So you're just dancing around a lot of noise, a lot of extra stress and putting your capital to risk. So I'd rather get in a little later when things have started to move up and you look at the market internals of how these sectors are moving compared to other asset classes and sectors. And when there's that conviction saying, hey, big money is actually piling back into these specific sectors, let's move into those leaders and ride them for this next rally. But we don't have that right now. The market is still kind of in a risk off. No one really knows what to do. I think we're kind of almost like in an early summer doldrums. There's not a lot of volume or conviction anywhere right now.
So when we look at the stock market and economic cycle chart, can you give us some perspective on where the commodities are starting to gain traction? Like if the commodities are starting to gain traction, where this puts us in the curve?
Right. So if commodities are starting to gain traction, which we have seen this year, they've definitely taken kind of front and center here. It usually means we're near the top of a bull market for stocks. We usually see physical. The way it works is the bull market for stocks, everyone piles in, drives the prices up. The PE ratios are kind of out of whack. We're all paying premiums for these stocks. And then suddenly there's a revaluation event where people are like, what, these stocks are crazy overvalued. Everyone wanted stocks and real estate. And then they start looking at, well, what is undervalued? And you realize everyone's kind of ignored commodities and they start to move into commodities like oil, natural gas, gold, silver, platinum, palladium. We're starting to see people move into a physical asset that actually, costs money to get out of the ground, has physical value, has use. Especially with a dollar that has been devaluing, you really want to move into these because the commodity values are going to go up. So that's telling us that we're late stage of a bull market. Doesn't mean the top is here yet. We could still see some of the biggest moves happen in the last 10% of a stock market move. So we could have a big rally into year end here in stocks that blows everyone's minds, and then it ends up rolling over. All the commodity strength is telling us is that, hey, there's big institutional money and money starting to move into physical assets because they feel as though they're valuable and they're undervalued right now.
So, Chris, why are news-driven events for an asset class something that you warn against trading around?
Yeah, well, news events are they're really tricky because when you have news, it means everyone hears about it at the same time. You usually see huge volume on the chart. I talked about this yesterday as well with followers. Was when you have a movement in price that is on just kind of average volume or low volume, that is actually a sustainable type of rally. But when you get a move in price based around news and volume spikes huge, you know it now has mass media coverage. And the general public is now piling on it. They got the FOMO, their fear of missing out on this crazy news, and everyone's doing it. I want to do it. And what happens is they push price beyond how quickly it should go up in value or down in value. And then quickly the market has a way of reacting and resetting itself. So people end up paying a premium, and then a couple of days later, it drops right back down to where, it should have been, if it was just continuing to kind of work its way up the chart. So it's very deadly trading around news, unless you're a day trader, because you're in and out end of day. You don't have to wake up the next morning with it 50% higher or 50% lower, which happens in a lot of these events like AMC, GME, the silver squeeze, that was a big pop and drop as well. So they're dangerous.
So you've said that big smart money knows what's going on. So how do you try to watch where this smart money is being directed, Chris?
Yeah, so I look at a lot of different sectors. So I use kind of intermarket analysis. So I like to look at what utilities are doing. Big money, when they starts to get nervous, when they think they're maybe overpaying in areas or for stocks, or they think that we could have some type of contraction, big money naturally will start selling off other assets. What were the leaders? They might go into a defensive play, like utilities pay good dividends. And also, if we go into a contraction, we're still going to need running water. We're going to need sewer. We're going to need electricity. So all those things are utilities. They're not going out of business. So that's when we see utilities start to perform really well and outperform the stock market. That is a sign that big money is kind of smartly moving into defensive plays because they feel a little nervous that something might happen. We also see money move into the bond market, the Treasury yield bond. TLT is a good ETF for that. When it starts to it's putting in what looks to be a major bottom. When bonds start to rally, which is a huge market, takes a lot of money to move the bond market. Well, bonds are starting to move up. They're starting a new uptrend. Big money has obviously got to come from somewhere to go into bonds, and typically that is going to be the equities market, out of stocks into bonds. There's that kind of rotation, and so those are kind of the key things I really look at.
Is there a seasonality aspect to this move as well? This kind of, let's say, move to a safer asset.
I don't know if there really is. I think there's just waves of sentiment where people kind of are so energized and making money from the stock market. It creates a wave. Like January is usually a really strong time. October is usually a low, but come October, the market cleanses itself usually with a sell-off. But then it's the last quarter. This is it. Last quarter for traders and investors to make back money they lost, or to make a big push and make a lot more money. So it's kind of like the beginning of the year, the last quarter of the year, people put on these pushes, and we can see kind of that type. That's why we see the holiday rally, right? The November, December run is everyone's kind of naturally excited to try and make the year with some killer results. And right now we're kind of in this seasonality. To me, it feels like we're in the kind of summer doldrums. It's the market's just kind of low volatility. Prices aren't moving much. They're slowly grinding higher. Most sectors are just chopping around. I think people just aren't focused on the markets right at this moment.
So, Chris, what other relationships are instructive to you? What about something like the NASDAQ and transportation index divergence?
Yeah, I mean, you look at the NASDAQ over the last several weeks, it's been running higher. It's pushing to some new highs. The transportation index has been selling off for the last month and moving lower. Not that it's crashing, but it's just been fading and drifting lower. They're both very, very different spectrums. Like you look at transportation, And that is usually a really good leading indicator of what the economic climate is doing. And so if the transportation sector is selling off, those are the companies, the firms that are seeing, the demand way ahead of the general public. They're going, wow, we don't have nearly as many containers to ship in the next month or two. Sales are obviously down. But by the time, all that comes through to the economic data, it's like a month or two later. And then we find out we've got, weaker than expected retail numbers and all that stuff, which is kind of what's happening right now. And so you want to follow the transportation for an economic kind of view on the markets. When you look at technology, it's been going up the opposite direction. It doesn't require delivery. And we're in definitely an information-rich environment right now. The business world, the education world is like on this new digital passion-driven economy where everyone wants to do what they love, they want to share it, and it's instant online, right? So they're both very different spectrums. The transportation sector is telling us that the economy might be slowing a bit, and maybe stocks are going to start to struggle a little bit more. But the technology side is saying, hey, there's still, there's a lot of upside potential, and people are really just starting to get wound up with work from home, online businesses, focus on online marketing, and that the tech side, I think, is got a lot of upside still. So before we hit record, you and I were talking this morning about volatility. So how do you use volatility to really, as another barometer of what's going on in the markets? Yeah, so if you look at the volatility index, like the VIX, right now it's trading down near some lows. And to me, the VIX is a good gauge of what the general public are thinking and feeling. So when the VIX is low, the saying is, when the VIX is low, it's time to go. When the VIX is low, that means people are not afraid of falling prices. They think it's just going to go higher, the stock market. And when everyone feels like there's no, it's just going to keep going higher, that's when, something bad's about to happen. It's always right when you get comfy, you get shaken up, right? So that's kind of like the way I look at it. In the stock market, even though the VIX is low, the stock market can keep grinding higher, just like it is now. You look at the SP 500 over the last 3 weeks, it's got very narrow range bars on the daily chart. It's just slowly walking up the 5-day moving average. And it can do that for a really long period of time. But eventually, we're going to see a very sharp red bar. The VIX will start to spike, and we'll start to see fear come back into the market, and it'll kind of shake things up a bit. Do you ever try to place options on the VIX to use it as more of a defensive way to capture some upside when equities are crashing, or do you use it more just as a signal? I for trading ETFs, I don't trade options too often. We've got an options guy. We run an options newsletter, and he loves the VIX, and he loves to write options. So, for example, over the last month, he's closed out 8 or 9 winning trades back to back, just selling premium. It doesn't really matter which direction the market goes. He can just sell premium and collect it. And it's a very powerful strategy. On my side of the equation, where I focus on ETFs and equities, I look at the VIX as just a heads up saying, hey, at any point here, this market could start putting in a top because there is no fear. And I just keep my eyes peeled on that. When there's no fear, the bonds are starting to rise, utilities are starting to rise. That to me is telling me that the general public's not afraid. Big money's moving into defensive things. They're already getting positioned for a pullback, right? And that's the scenario we're just starting right now. And it could last a month or so. And that's when I think we're going to probably see a new set of market leaders come out, which precious metals and miners, I think this is their prime time. They should come to life over the next month or two and become one of the top market leaders. We've seen this happen over and over again when this scenario plays out, and we're just kind of getting into that right now. So as you're mentioning the metals and the miners, Chris, what other indicators do you look for that point towards the metals and miners starting to move? I just usually look at the price action. Typically, I want to see gold miners and silver miners outperforming physical bullion. But a lot of it also hinges around what the US dollar is doing. We've seen precious metals have a really nice move over the last month or two to the upside. They're all testing a resistance area. So they've had a good run. I would like to see them continue to pull back. They have been for a couple of weeks. They could still pull back for another week or two. potentially longer, because the dollar is on the verge of popping and having a big move to the upside. And that'll take the wind out of the sails out of the precious metals and commodities for a few weeks. But then I think the dollar will just roll over. It's just an oversold dollar. It just needs to kind of have a bit of a bounce and squeeze out the short positions on the dollar. But once that dollar kind of tops out and starts to roll back over, I think that's when we're going to see precious metals have that next big run. But really, when it comes to the precious metals, they've started a new short-term uptrend. Once we see this dollar have a pop or actually start to break down, that's when I think we're going to see the precious metals sector start the next big run. I think it's potentially less than a month away, so it could be really exciting going forward here.
So, Chris, as you're mentioning the dollar pop, would you mind pulling up that chart so we can look at it a little bit better and maybe go through some of the reasoning why you see a dollar pop coming?
So, if we take a look at the dollar, you can see this is the daily chart. It's been carving out what looks to be a bit of a bottoming formation on this chart. We've got resistance right across here the last 2 trading days, and it's on the verge of popping. And just based on the depth of this and the next resistance area, which is right up in these highs, these lows, and this high over here, we could see the dollar pop very quickly up to 91.50. It's not a huge move, but it's enough to take the wind out of the sails a little bit for precious metals. And if it breaks that level, then we're most likely going to go up double that height, which would be around the 92.50, which is kind of this consolidation through here where we had a bunch of bars, also had a breakout, and then of course there was a previous high, and a whole bunch of times in history it kind of tagged that level. So I think the dollar could end up having at least a little pop and rally and go a little bit higher. That is going to stall out metals for a bit, but in the grand scheme of things, I think we're going to see the dollar end up heading lower again later this year. When you look at this chart, it's in a strong downtrend, and a little pop up into this area, I think we'll end up getting sold back off into. And I think we could see something similar to what we saw over here, where we get a pop, and then eventually it breaks through these lows and sells off. So if the dollar breaks these lows over here that we saw earlier this year, or these lows, that is when we're going to see precious metals, take those mega runs to the upside. And we're going to see, gold probably 2,700 or higher. Silver will probably be, $40 or higher very quickly. So that's kind of what the dollar is pointing to. This is a weekly chart, so we're looking at 3-4 weeks out. Quick little bounce up, and then it could fizzle back out, and then the markets take off again.
So as we're talking about this slide in the US dollars, this is what you're saying is going to add as a catalyst to the gold price?
Yeah, so the monthly chart shows it the best. When we look at this chart, you can see this really strong support level, these lows that we hit this year, and all the way across. You can see how if I just put my cursor, you can see the horizontal line. We're at this really significant pivot zone. Price is either above this clearly or below it, right? If we break this line, this low over here, gold's going to go down to 80, maybe even 75. Sorry, not gold, the dollar. And that is going to be the spark of a massive run in precious metals. The last time we saw a major breakdown in a pattern was like over here in 2002, where put in a topping phase, it sold off, and then really it kind of was trying to hold its ground, and then it broke and started the new bear market. Well, breaking this support level would be the start of like a new major bull market in the dollar, which means, a new bear market in the dollar, and it would spark a new big rally, a bull market in precious metals. So this is the line in the sand, this kind of 88, kind of 30, 88, 40 area. When the dollar breaks down from there, that's when precious metals are going to go absolutely ballistic. It's going to be interesting to see what the premiums are on buying physical. I mean, the premiums are so out of whack right now, but what happens when, those metals are soaring? How far out of whack are those premiums going to be? I think buying cheap gold and silver, or fair value gold and silver at like spot price, those are like pretty much done. And those premiums are just going to get way out of whack going forward. Once the herd mentality piles into precious metals, the premiums are it's going to be extremely painful. You really needed to kind of get into metals a long time ago because the premiums now are just ridiculous.
Mm-hmm. So let's move on to the gold chart, Chris, and have a look at that if you don't mind.
Sure. So this is the daily chart of gold, And you can see here, it's still making a series of big standout highs. If we look at the standout highs, it's kind of still making a high, a lower high, a lower high, a lower high. So it's had a nice run, but it's not really fully, broken these levels here and really started to take off. This 1960 area is going to be a real critical level. Over the last couple of weeks, we've put in this kind of three-wave correction in A, B, C, which is good. That cleanses the market. But if the dollar has a bit of a pop, I think we're going to continue to see gold trade sideways or lower for another month or so before it starts to pick up speed. Now, the nice thing is we are seeing price back above this green line, which is the 200-day moving average. We're about to see the 50-day moving average cross back above it. So that's like a golden cross, a bullish cross. That's telling us that there's some long-term strong upward momentum in gold. And when we go and we look at, say, the monthly chart of gold, if we look at this monthly chart of gold here, you can see just based off these spike highs, we broke last month. We closed above that level. So we got this big run, this big bull flag, a nice A, B, C, a three-wave correction. It's this C wave, that third wave that breaks a previous low right here, that creates panic selling. People get shaken out, they spook out of it, and then it kind of cleanses itself, and then it starts to rally. So we're just kind of breaking above the monthly chart, starting a new bull rally here. And it broke out last month. This month is pulling back a little bit, taking a breather. But overall, this chart is pointing to $2,600 over the next year or so. So there's a lot of upside based on the monthly chart, and it's just getting started.
Chris, as you're mentioning the let's say the behavior of people when you get that last C wave correction, do the algorithms, the high frequency trading algorithms typically follow that same type of model? Do you know?
Well, a lot of the algos, I mean, I'm not everyone's so differently, but algos like volume. And when you have that C wave, that third wave that breaks support, and there's this huge flood of stop orders getting triggered, because a lot of people will put their stops under a recent low, and they say, hey, when it breaks this low, get me out. And so, during this point here is where you usually see elevated volume for a short period of time. And that's when algos will step in. They'll go, whoa, there's a ton of volume surging. Let's take advantage of it. I wouldn't say they're focusing on ABC corrections, but they definitely focus on volume, and they naturally want to move to where there's lots of liquidity, because that's what they want in order to flip shares back and forth.
So does the silver chart look very similar to the gold chart right now?
Take a look at silver. The silver has actually been holding up in a bit different of a pattern. It's got a very strong rally, and then it's just been kind of creating this holding pattern. It's a very explosive pattern that points to a lot higher prices, just like the chart of gold. Both of them are very bullish patterns, but gold has been, gold had a rally up and then it kind of flagged down for a while, whereas silver pulled back and is traded sideways, and it keeps making actually higher lows, but it's kind of traded sideways along these highs. So silver's actually got a stronger relative strength, and that's what you want to be in. You want to be in the leaders, the strongest sectors, because when the market becomes favorable for that sector or commodity to run, the ones holding up the best are the ones that usually naturally float and take off and just keep going up and up and up the quickest. So silver's primed and ready for that. It's definitely got some serious resistance all the way up to around this $30 mark. But once it breaks out, I mean, it's going to $34 probably, very quickly within a few days. And then 40 is kind of the next target for it based on this chart pattern. So I like silver a lot. I like them both. I really actually like the gold chart in terms of the bull flag pattern. You really do need to own both. Silver is naturally going to move more percentage-wise, but both of them have got very strong chart patterns going forward. So,
and historically, silver typically leads. Is that true?
I always find silver lags in the bull market. Typically, we see gold miners first, and then gold, and then silver kind of pops and takes off at a random time, whether it's delayed 4 or 5 days. Sometimes it's delayed actually a couple of months, and then suddenly it plays catch up. So that's what's weird about silver. It's kind of like its own little thing. It just kind of sits dormant and then pops. It's tough to trade, and you just kind of have to be in it. You need to own it. If it's got a bullish pattern and you're bullish long-term on it, you definitely need to be in it, because at any point it could pop, 5-8% in a day, open up higher the next day. And it sucks to, sometimes have to chase prices up to get in. And if it happens on a lot of news, if it happens to be a news-based pop that creates a squeeze, and I got a feeling this is what's going to happen. We're going to have some type of news event, some new, create the short squeeze. It's going to create the hype. We're going to see price get above 30. Everyone's going to want to jump on, and it would be a breakout. But the thing is, it could be on mass news, and it could just be a big shakeout, like where price goes up, everyone piles in, and then it just gets clobbered and comes back down and falls back into a sideways mode. So I really hope these breakouts don't happen to be around a news event. I hope they just kind of happen naturally and don't get hyped up, because hypey moves usually end up in a sharp reversal. You pay a premium on the breakout, and then it just crashes right after. News wrecks patterns. It really does.
So in that vein, Chris, when we're talking about news, I recently saw that you wrote a little bit about Basel III, how that could be positive for the gold price. So is that more of a fundamental reason or a news-based reason?
Yeah, my partner talks about that. I mean, I focus strictly on technicals. So, I just like to look at the charts and the momentum. Obviously, the fundamental story is so powerful for precious metals, and it has been forever. But the reality is, precious metals have been going down and down and down, and they don't budge. And my stance. I really don't care about the fundamentals in news. It's nice that they support the direction that the charts are pointing to now. Now that they're both in favor, I think we should see them go higher. But when push comes to shove, the only way we make money is getting into something that's moving in our favor. And that's what I focus on with the technicals. Get in when it's moving, get out when it's showing signs of being dormant, and try and find a hot spot to put your money that is moving.
So as you were saying, Chris, the gold miners really start to lead. So why don't we have a look at the GDX or GDXJ, whichever one you feel more comfortable with, and see kind of any price action there.
Yeah. So the large caps had a nice pop and break. This is the monthly chart, and then they've obviously been out of favor for the last 8 months or so, and now we've started to see them pop and break to the upside. I'm just going to go to the daily chart real quick here. So they've been moving really nicely. When we look at the daily chart, you can see we are back above this green 200-day moving average. We're the 50 days above it as well. So we're back into a bullish stage for this sector. Ideally, we want the 200-day moving average to be sloping up as well. That it's not ideal that it is still sloping down, but it's not like it's crashing. But we are making a series of higher lows. We're making a series of higher highs, and we definitely have broken a previous standout high over here on the chart. So now we've kind of broken through resistance. We've flipped that momentum that was a consistent downward bias. Now we've kind of pushed up, and we kind of got that upward momentum again. And now it's just pulling back and taking a bit of a breather. And I think we're going to see gold miners continue to kind of trade sideways and flounder, but they are forming a very strong bullish pattern. And hopefully they kind of move first. I think we could see these have a very big run back up to these highs. If we were to just use a Fibonacci extension tool, we can get an idea of where we could see gold miners. This is the GDX. Based on the current pullback, could bring us somewhere up to $46 a share going forward, which is just above these highs. Generally, what I look at is if there's a target set just above it, I usually put in a first profit target somewhere just below those highs, because sellers tend to step back in. It can sometimes end up being a double top. So I always take the most conservative play, but we've got a really nice momentum move here to the upside, and we just need to find some traction. This 50-day could end up being a significant support level, and we see gold miners trade sideways. But over the next few weeks, we should see gold miners moving higher again for sure.
As you're mentioning that previous top there, Chris, is that somewhat of a psychological barrier, as you're saying, to kind of take profits around?
Yeah, it'll now previous highs, previous lows naturally act as either a resistance or support zone. But I mean, when you look at the price action, depending on where you draw these levels, it's naturally going to be a resistance area. Like technically, this is where the market it kind of pushed up and pulled back. This is where it started the new launch pad to go forward. And if we were to look at those levels, I mean, the target is pretty darn close to that upside. So not only is it psychological, it's also a whole number, $45. Typically, people are saying, hey, if it gets to $45, I'm going to sell it. If it gets to $50, I want to sell some. If it gets to 55, it's kind of like these whole numbers, right? So every $5 increment in a stock this priced at this level is usually going to act as a short-term resistance zone. Every decade number, 50, 60, 70 is going to act as an even more powerful resistance or support zone. But we've got our short-term technicals also saying, that 55, 56 area is where momentum is going to actually start to stall out anyways. So if it's slowly starting to stall out and then you throw in a previous high, which people are going to naturally want to take money off, it's also a whole number. It just adds more pressure and you're probably not going to get past it on your first push. So that's the first level where price could reverse and it could trade sideways for months after that. So you got to make sure you pull some money off the table and see how it reacts at that point.
Excellent, Chris. Why don't we have a look at the energy chart, like maybe the crude oil chart?
Sure. All right. So if we just get rid of that big spike. So more or less crude oil, it had a huge run. It consolidated last year and then it broke out of that run. And believe it or not, 64, 65 was the upside measured move for crude, which seemed pretty extreme when we were trading back in the 40s. We ended up hitting that. It's traded sideways for the last several months, and it just broke out over a couple of weeks ago, and it continues to kind of grind up this 5-day moving average. And its next upside target is $77. That's its short-term target. The next full 100% measured move based on this momentum is about $88 a barrel, which is going to catch a lot of people off guard if we get there. So there's still a lot of upside in crude, and maybe it'd be interesting. I mean, if crude oil gets to those levels, if it actually starts to play a role in mining stocks. Remember back when crude was above 100 all the time, we saw people always followed the price of crude oil, and if crude went up, gold would start to move because fuel costs would go up and down and fluctuate. So it'll be interesting to see if we get there, but there's so much supply out there right now. It doesn't seem like there's that much demand. I don't think we're going to get into that phase where crude oil is really dramatically moving precious metal prices, but we're definitely seeing crude move higher, and we're in that kind of strong commodity phase where gold and oil are moving up together.
Excellent, Chris. Is there any other charts that you'd like to go through that you find instructive at this time?
I mean, what is kind of interesting when we look at the energy sector is crude oil has been moving up here the last couple of weeks. If we were to take a look at the oil and gas exploration sector stocks over the last couple of weeks, they've actually been kind of stalling out, and it's kind of a little bit of a red flag that we're seeing that happen. If the stocks are underperforming and constantly gapping higher and selling off, there's obviously some big sellers kind of stepping in doing that. And when you dig a little deeper, we take a look at the gas, because this is gas and oil. Looking at natural gas prices, you can see we're at this really significant potential triple top. Each time we got up here, we've seen natural gas sell off. This was like 30-something%, 26%, and we could see natural gas sell back down potentially to the 200-day moving average or more. And so it's interesting that the energy sector, it might be a little long in the teeth. Energy stocks could, across the board, big and small caps, just be under a little bit of pressure while natural gas sells off. Crude will do a lot of the heavy lifting still. It's the bigger, dominant kind of commodity. But anyone who's heavy in the energy sector, just be aware that natural gas is probably going to fall 15 to 20%, and that could stall out the equities moving up in the near term.
Chris, as we're talking about these real, let's say, big swings, big volatility, do you mind looking at the Bitcoin price and telling us what you're seeing from that chart?
Sure. Yeah, Bitcoin's been quite the roller coaster, and the monthly chart gives you the really good view of kind of the parabolic move that we've seen. Obviously, wow. What goes straight up in his headline media news and hype usually comes straight back down. This is how we started our talk off. How do we trade around news? Well, it creates huge movement. There's huge risk, and what goes straight up. I've said this for years. What goes straight up usually comes back down for half of the move, at least, if not all of it. And believe it or not, the futures for Bitcoin start at 2018. But going back in time, Bitcoin has done this exact type of bubble. People don't like to call it a bubble, but it's a bubble. It's done these bubbles, 6 times in the past. Each time it's corrected on average 74%. And Bitcoin has only corrected 54% at this point. So there's still more downside potential for Bitcoin. It doesn't mean it's not going to go higher. It just means it usually takes at least a year for this damage to kind of work itself out. This was a bit of a bubble, coming down. It took more or less a year before it started another rally, and then it took a year before it started another one. This chart isn't a very good view of that, but when we look at the potentially the daily chart here of Bitcoin, there's still potential for another drop in price. It's kind of lingering sideways here. I've got a downside target of 16,000 for Bitcoin based on the momentum, and that would cleanse the price. It would bring it down to what it's done historically. It would kind of wipe out most of this big rally, this kind of euphoric bubble, and then it would eventually come up and build a new platform, and then probably the next run it'd probably go to $100,000. But I just don't see that happening anytime soon. This type of pattern in price action, when you look at it from a monthly chart, go back to 2010, it's most likely going to take at least a year for it to build a new base, stability. Everyone who's now underwater is eventually going to get tired and give up on it over the next year. They're going to sell their Bitcoins to new positions where those people are now willing to hold on to it for a long time for the next bubble. And then it's this rinse and repeat. So that's kind of how I see Bitcoin moving. I think long-term it's still going higher, but I don't think it's going higher anytime soon yet.
When you're mentioning these, let's say 6 previous bubble formations in the Bitcoin chart, is there any, let's say, similarity between them that you would be able to apply some type of a trading strategy to, Chris?
Well, yeah, like trading bubbles are tough because when they collapse pretty quick. So the first thing is to identify and know that, hey, we're now in like nose bleeding territory. We're bubble high here. And when you're in a bubble, you do need to be trimming off positions. As much as you hate to sell something that just keeps going higher and higher by leaps and bounds, you do need to trim off positions. Eventually, when you have a big crack to the downside like this, where something came all the way down, it broke a previous low, it broke 2 previous lows. When you break 2 previous standout lows, that's usually a trend has shifted. And then, of course, it kind of rallied back and really struggled to get any traction. And you can typically see this. I call it's a complacency move. People still think it's going to go higher. From a technical standpoint, you're like, okay, there's been damage done. We're making lower lows. We're now looking like we're making a lower high. And then as soon as it starts to break down, you could play the downside. Or you just liquidate and you let it do whatever it's going to do and focus on it later. The key is, trimming profits. It's not about trying to make as much money as you possibly can and getting out of the top, because if you do get out of the top, it's a total fluke. I mean, I traded a penny stock earlier this year, and I just kept scaling out, and I sold it at the highest tick, the last portion of the position at the highest tick, because everything was showing it was a blow off top. Total fluke, but it feels absolutely amazing. But you just have to be scaling out. And now the thing's, it's down like 70% from where it was. And if you can't, I knew it was in a bubble, and which is why I was scaling out. And I just got to the point, I'm like, I am happy with these results. I'm going to close off the rest of this. And that was an absolute amazing trade. And I'll just wait for a new opportunity. It could be the same stock or not. You kind of got to do the same with this. I mean, if you're a hardcore believer of Bitcoin, you keep some long-term for sure, but there's no point in riding out bubbles because they don't end well, right? You can always add later when it does actually have a pullback. Even if you buy it at the same price later, at least you're going to get in when it's starting a new upswing versus having your money locked into it for potentially a year when you could have put it in precious metals or you could have put it in the tech sector or whatever is hot at that time.
Yeah, that's a great point. So, Chris, when you're mentioning the penny stock that you were scaled out of, you're saying that it ended up being in basically major bubble territory. So,
Yep.
did you have indicators of it being way overbought at that point? Was it the measured move of how far it had to run? What were you looking at that was indicating that to you?
Yeah, usually I use Fibonacci extensions for everything, so you can get a feel for where the upside resistance is going to be. But when it comes to a penny stock, it's kind of more of you kind of have to really feel it out. I mean, you can check some of the forums, the different sites of everybody talking and chatting about these things. It's a totally different game playing, penny stocks than it is like an ETF. And so you can feel the momentum, you can feel the hype, you can see the volume start to really spike and take off. And, if something goes from 6 cents to, $2.34 in a short period of time, you're just pretty much, whatever's happening is going to eventually come to an end. And when the volume hits crazy levels, you have a couple of days where you see a huge spike in price, and then it crashes right back down. And then another day it gaps really high, and then it sells back down by the end of the day. That's when those are exhaustion gaps. There's big money rotating out. And as soon as I see other big money and the media kind of driving it up at the opening bell or before the opening bell, and then when it opens, people are selling shares. That's the red flag. As soon as you start to see these big gaps, you gotta whoa, I'm out. This is it. If it gaps higher tomorrow, I'm just closing it, right? So it's a real kind of science experience blended art and science kind of play here.
Mm-hmm. Excellent, Chris. Well, I think there was a lot of great advice there in that in that explanation. Do you have anything else you'd like to add for our audience before we wrap up here?
I think we covered it. I think we covered a ton of stuff, and it was good. Yeah.
Yeah. Of course, you're available on Twitter at the Tech Traders, and all your links are from there. We'll put them in the show notes as well.
Yeah, great.
Perfect. Thanks for your time today, Chris.
Yep. Thanks for having me, Tom. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.